This is the most challenging economic situation that many famous retailers have ever faced, and recent figures are proof of it. Retail sales fell again last month as inflation continued to hit hard. Purchasing power and rising interest rates have limited access to credit. Companies are paying more for their products, labor, energy, and transportation, while their profit margins continue to shrink, and their debt reaches unprecedented levels. Many of them have been struggling long before the current crisis began, and have been hanging by a thread that could break because economic conditions will worsen this year. That's why today we have listed several declining popular brands that may disappear before the end of 2023. Here are the major retailers collapsing before our eyes. Staples. The decline of this iconic office supply store began almost a decade ago when it closed 225 locations in 2014. These closures resulted in revenue losses of hundreds of millions of dollars. When the pandemic hit in early 2020, the company was already in serious trouble with a debt of $5.325 billion, while sales generated only $1.514 billion in revenue that year. Since then, the office supply retailer has never fully recovered, especially amid the remote work boom. The company was forced to close another 200 underperforming stores and cut thousands of jobs while trying to balance its finances. More recently, with inflation forcing Americans to focus only on essential purchases, the chain's sales dropped by 6.7% in the first quarter of 2023. The growth of online competitors like Amazon threatens to render stores like Staples redundant. The fate of Staples remains uncertain given its current liabilities, and it wouldn't be surprising if the worst-case scenario unfolds. David's Bridal. After more than 7 years in business, David's Bridal filed for bankruptcy in 2023, and we may have to bid farewell forever to this famous wedding apparel brand. In April, executives pointed to inflationary pressures and decades of changes in the wedding industry as the main reasons for the company's decline. Over 9,000 jobs were eliminated, and today the company is trying to restructure its debt. But creditors don't seem too optimistic about the chain's future. If a buyer doesn't emerge to save the company, CEO James Markham stated that the chain would be completely liquidated before the end of 2023. However, considering that sales dropped by 22% in the last quarter, it will be very challenging to find someone willing to buy a money-losing brand in a recessionary environment. Walgreens. The empire built by Walgreens over the past 122 years seems to be crumbling in 2023 as losses continue to mount. The pharmacy chain, which operates nearly 8,700 stores across the United States, announced 450 closures for the year. In March, the company's stock reached an 11-year low of $28.64, following Walgreens executives' downward earnings forecast for the year and predicted weak sales growth for the third and fourth quarters. Since January, the stock has fallen by 17%, and worse yet, Walgreens has lost 67% of its market capitalization since it peaked in June 2022. Its massive debt and other obligations make the chain look like a risky investment at this particular moment, particularly because financial experts are concerned about its ability to easily meet these obligations, either through free cash flow or by obtaining capital at an attractive price. If it fails to pay its creditors in the coming months, the company may declare bankruptcy due to its $13 billion debt load. As of its latest earnings report, Walgreens only has $1.84 billion in cash. Rite Aid. Meanwhile, its competitor Rite Aid has also been facing growing challenges. The truth is that the company has been in its final stages for years, and the fact that its rivals enjoy much larger scale and generate significantly more cash flow is causing Rite Aid to fade into the background. After selling 2,000 of its stores in 2018, conditions have only worsened for the pharmacy chain, with the organization getting smaller and its profitability potential sinking. Foot traffic has seen a persistent decline in recent years, and its stock has dropped by 41% compared to the same period last year and 65% in the past 12 months. Limited potential to change things could further accelerate the chain's disappearance during this recession. Victoria's Secret. Even after Victoria's Secret underwent a major overhaul since declaring bankruptcy in 2020, the clothing store has not seen a notable improvement in its financial results. After reporting a 9% drop in sales in January, second quarter sales fell an additional 7% as expensive items drove away American consumers trying to save. The rise of independent and online brands is making Victoria's Secret products less and less attractive in this highly competitive market. Over 300 stores have been permanently closed in the last 3 years, and at least 50 more are scheduled to close in 2023. The brand's costly problems are likely to intensify as consumer spending decreases amid deteriorating economic conditions and limited credit. Retail experts say a second bankruptcy could be on the horizon for the chain, as profitability issues have worsened even more in the past 12 months. Foot Locker, the shoe store. Foot Locker is on the bankruptcy watch list as its performance continues to disappoint amid declining customer traffic. In March, the company stated that it could close 400 retail stores in the United States and shut down another 125 stores operated by its subsidiary. Total sales for retailers in the first quarter of 2023 were $1.92 billion, compared to $2.17 billion year over year. Net income for the 3-month period ending April 29th was $36 million, a sharp drop from the $132 million reported for the same period in 2022. CEO Mary Diamond attributed Foot Locker's sales decline to the challenging macroeconomic environment, which forced the company to lower product prices to stimulate demand and manage inventory. As a result, the company's income is expected to decrease by a staggering 10% for the year. An 11.4% drop in sales in the last quarter also led to a 27% decline in Foot Locker's stock in a single day. The outlook is turning bleak for the brand, which desperately needs a new restructuring plan to survive the recession. Home Depot, the largest home improvement retailer in America, is concerned about the impact of a slowing economy on its business. The company has just reported a bleak quarter as consumer spending on home improvement projects sharply declined. The retailer posted disappointing sales for its first quarter and lowered its outlook for the year after customers cut back on their spending. Home Depot's same-store sales dropped by 4.5% during its last quarter, and its revenues decreased by 6.4% compared to the same period the previous year. Total revenues for the quarter dropped by 4.2% year over year. Neil Saunders, managing director of global data and retail sales expert, noted in a recent report that Home Depot's declining sales trend is worrisome, reflecting an underlying weakness seeping into the economy. He added that the slowdown in housing market activity as high interest rates deter some from refinancing or taking out mortgages for their first homes can have a chilling effect on the home improvement category. The second factor is the overall decline in spending even among those who aren't moving. Saunders pointed out that the number of households undertaking projects continued to decrease this quarter as people are cutting back on discretionary spending and postponing major renovations that sometimes require financing. Home Depot noted that buyers are also refraining from purchasing larger, more expensive appliances. All of these factors are leaving the giant retailer in a precarious financial position, and these factors could trigger a series of systemic failures that could undermine the company's health in the coming months. In conclusion, these iconic retailers, which have been household names for years, are facing significant challenges due to a combination of economic downturns, changing consumer preferences, and increased competition from online giants. Their struggles highlight the evolving landscape of the retail industry and the need for companies to adapt quickly to survive in these turbulent times. The fate of these brands remains uncertain, and only time will tell whether they can weather the storm or succumb to the pressures of an unforgiving economic environment.